Salesforce stock is down about 15% over the past year, but yesterday it jumped nearly 5% after management raised their long-term revenue forecast to over $60 billion by 2030, well above the $58 billion expected by analysts. So the big question is this a great opportunity to buy Salesforce now? Let's take a closer look at the fundamentals and run a DCF model to estimate the company's intrinsic value and potential future returns. Over the past decade, Salesforce has delivered consistent revenue growth, going from around $6 billion to $29.5 billion today. Analysts expect this growth trend to continue, with revenue projected to nearly double to $60 billion by 2030. And given the company just raised its own guidance, that looks perfectly reasonable. Profitability has also improved significantly. Net income has climbed to about $6.6 billion, and one of the most impressive aspects of Salesforce business is its free cash flow, which has doubled in recent years to $12.4 billion. Looking ahead, analysts expect profits to keep expanding, from $6.36 per share this year to around $18.11 per share by 2030. If we apply a 20 price-to-earnings multiple to those projected earnings, we get a target price of roughly $362 per share, implying about 47% upside from current levels. And there's a solid fundamental basis for this optimism. Salesforce maintains excellent margins, with gross margin of 77% and free cash flow margin of about 32%, both indicators of a strong, efficient business model. Now, to determine the company's intrinsic value, I run a 7-year DCF model under 3 different scenarios: low, base, and high assumptions. And the intrinsic value according to my low assumptions is $175 per share, middle $297, and high $480. And the stock is currently trading at $246 per share, which means that if my low assumptions occur, you would get a 4.1% annual return on your money, middle 13.4%, and high 22.5%. And I believe my assumptions are reasonable, as I have Salesforce growing revenue between 8 and 12% over the next 7 years, averaging a profit margin and free cash flow margin between 20 and 35%, and I assign the PM price to free cash flow at the end of the 7 years of 17, 20, and 23. But if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. Moreover, the stock currently trades at a price to free cash flow of just 18.9, the lowest valuation in a decade. The balance sheet is also solid, with $15 billion in cash against $11 billion in debt, a very comfortable position for a company with a $234 billion market cap. In conclusion, I believe Salesforce is a fantastic business with strong fundamentals, solid profitability, and a compelling long-term growth outlook. However, even though the stock appears attractively valued relative to its historical averages, I'd prefer to wait for a deeper discount before buying. The reason is simple. I believe the US stock market as a whole remains significantly overvalued, and I only want to invest in companies that are trading at truly compelling undervalued levels. As you can see in this chart, the market's current valuation is approaching the extremes we last saw during the dot-com bubble in the 2000s. I hope you found this video valuable. Let me know what you think about Salesforce stock in the comments, and I'll see you in the next one.